Good morning, dear learners, and welcome you all to the next lecture of my course on financial literacy. I, Dr. Vandana Sonkar, Assistant Professor at Faculty of Commerce, Banaras Hindu University, welcome you all to the week number 12, where we are discussing about the trading mechanisms. We have discussed about the different types of aspects under the trading mechanism, where we had discussed about the options trading, as well as we had also discussed the various concepts like hedging and risk analysis. Today we will be going to discuss about one of the related aspects with the risk and the hedging analysis, that is the portfolio diversification and trading mechanisms under the financial market. So let us begin with the various contents that we will be going to discuss under this lecture. So we are here going to discuss about the portfolio diversification and its various types, as well as we'll be covering the topic of the advantages and disadvantages of the portfolio diversification for an investor. We'll be also going to understand the modern portfolio theory, what are the various aspects of this theory, as well as we'll be going to cover the concept of trading mechanism, in which we'll be going to understand what is order driven market and what is quote driven market. We'll be also going to understand the various types of order in these two different types of market and key trading mechanisms and participants in the stock market. So let us start today's discussion with the first part, that is the portfolio diversification. Basically, portfolio diversification is a strategy that is used by an investor for the purpose of managing the risk involved in the investment procedure. That means the portfolio diversification is a strategy in which the investor try to distribute their investment funds into the various types of the asset classes that are available to them, and with the help of the inclusion of different types of assets and securities in their portfolio, they try to diversify the risk involved in the investment procedure. The goal of this particular procedure is to minimize the overall risk included in the investment strategy, while aiming on more consistent and reliable returns over the time. Here, by combining the investments that react differently to the market conditions, especially those with low negative correlations, losses are in one area and balanced out by gains in the another area, helping the investor to smooth out overall portfolio performance. So the diversification procedure is basically a strategy formulation for the purpose of minimizing the risk that is invested into the investment procedure of an investor. Now, after understanding the concept of portfolio diversification, let us discuss about the various types of portfolio diversification strategy that an investor can apply for the purpose of minimization of risk and enhancement of earnings in the investment procedure. So, the various types of portfolio diversification strategies that are available to the investors are asset allocation, geographic diversification, industry and sector-wise diversification of investment, and diversification by individual securities. So, these are the different type of strategies in the portfolio diversification that can be followed by the investor for minimization of risk. So, basically in the asset allocation, the process involves spreading the investment across multiple asset categories like the different classes of assets such as equities, fixed incomes, bond, real estate, commodities, cash, as well as the liquid asset in which the investor wants to invest their money for the purpose of minimizing the risk associated with the investment procedure. Here, since each asset class may behave differently depending on the different economic factors in the various types of market conditions, the combination of all these asset classes may help to balance the risk that may be involved in the investment procedure and maximize the return on the overall portfolio of the investor. Thus, it is a process with the help of which we can very easily diversify the risk of the investment procedure into the different classes of asset that may be available in the financial market. Now, the second strategy, that is the geographic diversification. This basically is the strategy that may be focused on investing your money into the various types of financial markets such as national market and international market. So, across different countries with the help of the different kind of investment strategies that may be devised for investing into the different geographical regions, we can diversify our risk involved in the investment. So, we can reduce the risk by being affected by a downturn in any one economy, and we can maximize our profits by any other economy or any other geographical area where their economic ups may be seen. So, basically global diversification or geographical diversification helps an investor to take advantage of varied economic trends across the world and reduce the dependency on the performance of a single economy or a nation. So, basically in the geographical diversification, we can diversify our investment portfolio into the different segments of the financial market such as the national financial market and international financial market. So, we can globally diversify our money for the purpose of investment. Next is the industry and sector wise diversification. So, even within the same type of stock exchange or stock market, we can very easily spread our investment across the different type of economic sectors. So, various types are technology, healthcare, finance, infrastructure and consumer goods. So, we can diversify our money for the purpose of investment into these different sectors of the economy, and we can adjust or balance the risk of one sector to the enhanced profitability of the other sector of the economy. So, this approach basically limits the risk of heavy losses in the one particular industry and may help you to experience a downturn with the sound financial planning that will help you to balance the risk with the prospective profits of the other sectors of the economy. So, basically in the industry and sector wise diversification, we can divide our money for the purpose of investment into the different sectors such as automobile industry, IT industry, consumer good industry, healthcare or infrastructure. Now, the last one is the diversification by individual securities. So, rather than concentrating on your investment in just a few number of companies, we can take the help of investing your money into wide range of stocks or bonds from the different companies in the financial market. So, this will help us to reduce the potential damage that may be caused by the poor performance or unexpected events related with a single company or single type of a stock or bond in which we are investing our money. So, instead of investing into the individual securities or putting all your money into same basket, we can diversify our risk by investing into the securities of different companies in the market and different asset classes of the market. So, the various types of the portfolio diversification strategies involves the asset allocation, geographical diversification, industry and sector wise diversification and diversification by individual securities. So, these are the 4 strategies that we can apply for managing the risk. Now, let us understand the various benefits of the portfolio diversification. What benefits we may have by diversifying the money that we have at our disposal for the purpose of investment. So, the first advantage that we get is the lower investment risk. So, diversification of the investment money basically helps us to reduce overall risk in a portfolio and helps in spreading investment across various asset classes or security depending on the different categorizations. So, with the help of this way, we can very easily minimize and reduce the risk involved in the investment. If one of our investment in a particular class of asset performs poorly, it won't significantly impact or damage the entire portfolio. So, it will avoid the risk of putting all your eggs in the same basket. Now, the next advantage is a smoother and more stable return. So, since the different investments may react differently in the market condition, losses in some one or in some type of stocks can be balanced by the gain in the other types of stocks that we have included in our portfolio. So, this particular method may help to have more steady and predictable return over time during an investment strategy. Next advantage is better risk to reward balance. That means a well diversified portfolio delivers us a higher return relative to the amount of risk taken in the investment procedure. So, this means that the investor can earn more without necessarily increasing the risk level with the help of the portfolio diversification strategies. Next is wider investment exposure. That means it gives us the exposure to variety of investment opportunities across the different geographical borders, across the different type of sectors and industry, asset types and various other categorization may be there. So, basically this helps in increasing the chances of benefiting from the strong performance of any type or any part of the market when we are diversifying our portfolio. So, wider investment exposure may be there, as well as the next advantage is that it helps to manage the market volatility. The fluctuation, the risk of price fluctuations can be controlled with the help of this portfolio diversification. So, in uncertain or volatile market condition, certain investments such as gold or government bonds may tend to hold their value or even rise in case of the downturns of the economy. So, this will help to offset the losses from the riskier asset and providing us an opportunity to gain enhanced profit in the market, protecting our overall portfolio in the investment. Next is it encourages the long-term growth for us. So, by holding a diverse mix of assets and staying invested over time, investors can take advantage of long-term market growth as well as the power of compounding returns will also be available to the investor if they apply the portfolio diversification strategies in their investment procedure. Now, after understanding the advantages of the portfolio diversification, let us talk about some of the limitations of the portfolio diversification. If you have not analyzed and studied all the factors that affects your investment decision and you have made any mistake while designing your portfolio diversification strategies, then it may pose some disadvantages also. So, the various disadvantages are risk of poor investment choices. So, with so many options available, it may not be easy and convenient for an investor to choose the suitable as well as potential assets that can give them enhanced profit. So, the selection of unsuitable or underperforming assets may be a risk that can create various options of facing the losses in the investment procedure. So, making the wrong picks while trying to diversify can sometimes be worse than not diversifying at all for an investor. The next limitation is complexities in the management. So a diversified portfolio usually includes different types of investments, each with its own rule, performance patterns, as well as monitoring the needs of the investment. So keeping track record of all the assets can become complicated as well as time consuming procedure for an individual investor, and it may create confusions also, and in such cases circumstances they may make poor decision making related with the various investment choices. Now the next limitation is the tax complications. So different categories of the asset classes are taxed differently. We have in the previous modules discussed about the taxation aspects of the different kinds of investments avenues, and where we had discussed that we need to have a good understanding of the tax regulations for the purpose of effectively submitting or depositing the taxes related with the income of the different type of investment avenues. So investors may end up paying more taxes if they do not have proper taxation knowledge of the investment avenues, and it may need them to hire a professional help also to manage their taxes. That can again add to the cost of investment. So tax complication may be again costly affair for the investor to manage, and this can again reduce your profitability into the investment procedure. Then the next one is the increased cost. Next limitation is increased cost, as we have discussed, due to the various categorization of the asset classes that you are going to select in your portfolio. Your investment may come with higher brokerage fee. The fund management charges in the stock exchanges may be higher, and your transaction cost may also be higher. So diversifying your portfolio too broadly can also raise the cost related with the investment strategies, and it can also reduce the overall net return for the investors. Increased cost may also be a limitation to the diversification of the portfolios. Now, the next topic of discussion is the modern portfolio theory. This is a theory that was introduced by the famous economist Harry Markowitz in the year 1950. They have discussed in the modern portfolio theory the various foundational concepts related with the investment management. So basically they tried to contribute to the theories related with the building of the efficient portfolios for an investor and focusing on the various aspects of the investment strategy. The modern portfolio theory basically offers a quantitative method that can help the investor to choose the ideal combinations of the various types of investment avenues, and by analyzing a balance between them, the expected return of the portfolio can be enhanced and risk can be minimized in the portfolio of the investor. So basically the modern portfolio theory focuses on building the efficient portfolios for the investor by maximizing the profitability as well as minimizing the risk involved in the investment strategies by analyzing the assets and making a balance between the different type of classes of assets that are included in the portfolio of the investor. So basically this theory emphasizes on the smart diversification. That means you will not be only going to choose the high return assets that will improve your overall performance of the portfolio, but you will be also going to include some fixed income or return assets that will be going to balance the risk involved into the investment of the high profit making investment avenues. So at its core, the MPT theory is basically based on the idea that the investor can maximize the return for a given level of risk, or they can minimize the risk for a desired level of return with the help of preparing a modern portfolio theory. So, by selecting the assets that can behave differently from each other, the risk in the investment can be minimized. So, modern portfolio theory basically focuses on the diversification. That means it emphasizes that the value of spreading investment across the various asset classes such as equity, bonds and other financial products may help the investor to increase the profitability in their investment, as well as it will also help in reducing the portfolio risk that may be there in the investment procedure by including all these assets, because all of these assets may behave differently in the different market condition in the same type of economy. So, basically when the assets that you have chosen in your portfolio are not closely correlated, the strong performance of some of the assets can help in offsetting the weaker performance of the other assets that you have chosen in your portfolio. So, this can lead to more balanced and efficient portfolio for the investor. So, basically modern portfolio theory helps you to apply the principles of diversification and have balanced profits by the diversification procedure. Next is the efficient frontier. That means the modern portfolio theory basically introduces the concept of efficient frontier, which is a curve that represents the most optimal portfolios for the investor. So, basically the optimal portfolios deliver the best possible return for a given degree of risk or a given level of risk, or the least amount of risk that a particular individual investor wants to bear for a target return in the market. So, basically in the efficient frontier, the procedure is to adjust the mix of asset considering their expected returns, their price volatility and how they can move relative to one another. The investor can find multiple types of combinations that can lie on this frontier, and they can avoid the less efficient portfolios by selecting the efficient frontier portfolios for their investment choices. So, the modern portfolio theory basically discusses two of the aspects. One is the diversification and the second one is the efficient frontier, with the help of which we can diversify our risk and we can select the best and optimal portfolios that are available on the efficient frontier for the purpose of bearing a set amount of risk for a particular amount of return that we expect from our investment strategies. Now, let us discuss the next part of the lecture, which is related with the trading mechanisms. Basically, the trading mechanism is related with the stock markets as well as the various types of dealer markets and the over-the-counter market, with the help of which we can trade into the different types of financial securities, the different types of commodities and other investment avenues that are available in the financial market. So, basically, trading mechanisms are the systems or processes that facilitates the buying and selling of securities or the asset in various types of markets. So, the stock exchanges, dealer markets or over-the-counter setups are the trading mechanism that helps the investor to trade in all these different types of asset classes. So, these mechanism basically ensures that the buyers and sellers are matched efficiently and their trading practices may go on smoothly. So, there are basically two different types of trading mechanism. That means we can bifurcate all the available trading mechanism into two different categories. One is known as the order driven market and the second one is known as the quote driven market, or commonly known as the dealer market, from where we can invest into the different types of asset classes. So, let us first discuss about the order driven market. Basically, order driven market are the stock exchanges. In the stock exchanges, as we know, trades occur by directly matching the buy and sale orders that are placed by the investors. So, here none of the dealers are involved in the setting of prices. Instead, the trades are executed based on the price as well as the time priority in the stock exchanges. So, basically in the order driven market, the orders are matched automatically and no dealers are involved in the setting of prices of the financial securities. The various key characteristics of the order driven market are anonymous trading. That means traders do not know each other, that who is on the other side on the transaction, as well as the transparency in such cases of the market are better. Market participant can see and check the full order book, including the prices and the volumes related with the demand and supply of the financial securities. Here an automated matching of the orders are executed. That means the orders are executed automatically by trading systems or the algorithm. So, algorithm based transactions are also completed in the case of the order driven market. And last one is, it is a investor driven liquidity. That means liquidity depends on how actively the investor place their orders in the market. The various examples are the NSE and BSE, the most popular one, as well as all the other stock markets that operate as a order driven market. Now, the next one is the quote driven market or the dealer market. Basically, these are the markets where trader buy and sell through the dealers or market makers who continuously quote or bid for the buying and ask the sell prices from the other party. So, basically here the investors execute the trade practices as the dealer quoted prices are mentioned here. So, in such case automated matching of the orders of the investors will not be done, and the key characteristics of quote driven market are here intermediary roles are played by the dealers. That means they act as a middleman providing the prices as well as the liquidity of the financial security in the market. They also influence the price variation. Prices of the securities may differ between the dealers depending on the inventory that they have and the market views. That means the factors that can affect the prices of the financial securities in the market. It has lower transparency as the various participants may have limited visibility into the market-wide orders and the prices compared to the order driven segments of the financial market. So, basically the various examples are Nasdaq's or over the counter market, where the customer negotiated deals can be done and the dealers play an intermediary role in completing the trades related with the various financial security. Now, let us discuss what are the different types of orders that an investor can make in the stock market. So, there is market order. This type of order is placed when an investor wants to buy or sell a stock instantly at the current market price. So, that is why it is known as the market order. So, here the main focus of the investor is to focus on the quick execution of the trade and do not getting the best prices of their sales. That means the liquidity is the prime focus of the investor in such case of placing the market order. So, here the most effective or liquid stocks where the price difference between the buyers and the seller is minimal, that automatically matched by the orders placed by the various investor in the stock exchanges. Now, the next one is the limit order. Limit order basically lets you to set a specific price at which you want to buy or sell your stock. So, this kind of order will only go through if the market hits that price. That means it gives the investor a better control over pricing, and there is no guarantee that the order will get executed in the market. So in case of the volatile market, the limit order may be very useful, or whenever you are aiming at a particular entry or exit point, these types of limit orders can be helpful for the investor. Then the next one is the stop loss order. This is a protective strategy. As the name suggests, for preventing the major losses, you can make an stop loss order. So here you set a trigger price, and if the stock drops to that level, the system automatically sells your shares on that particular price. So it helps the investor to manage the risk by exiting at a position where the prices move unfavorably for the investor. So that means it is a protective strategy. You can very easily fix a particular trigger price below which you do not want to sell or buy a particular stock in the stock market. Now let us understand who are the key participants in the stock market. So there are retail investors, such as individual tradings can be done in a small amount, those who often use mobile apps or brokers and invest mainly with the various types of personal financial goals such as savings or wealth creation. Then there may be institutional investors, so big entities like the mutual fund companies, insurance companies or pension fund companies may be there. They invest in large volume and can also impact the market trends. So they rely on the professional research and development for the purpose of taking their investment decision. Then there are stockbrokers. So the stockbrokers basically act as an intermediary between the investor and the stock exchanges. They help in placing the order on behalf of the client and charge brokerage fee for their services. So they need to get registered with the SEBI and exchanges for the purpose of getting a license of working as a broker. Then there may be sub-brokers, that means the authorized persons. So they work under the main brokers to serve the client in a better way. So in the smaller region, they assist with the order placement and investment guidance to the investors, and they also need to have SEBI registration as the authorized representative. Then comes the market makers. The market makers basically provides the platform to buy and sell quotes for selected type of securities. So they ensure that there must be enough liquidity in the case of the thinly traded stocks. So in case of the Nasdaq or the quote driven market, you can find a major role that is played by the market makers. Then comes the jobber. This is a old term that is used for this particular intermediary. So basically it is the individual trading for personal profit and not for the client. That means mostly this kind of the term has been replaced by the proprietary traders or market traders in current scenario. Then comes the clearing members. The clearing member help in the settlement procedure of the trades when they are executed. So they make that the securities are credited in the accounts of the investors and funds are transferred correctly to the seller of the security. And then the next participant is the depository participant. So NSDL and CDSL are there, that we have discussed in the previous modules also. They help the investor by opening their demat account and managing the securities in the electronic form. So with this, we come to an end of this lecture. I hope by discussing the various topics such as the portfolio diversification and its various methods as well as its advantages and limitation, now you will be capable of understanding that what strategies you can adopt for minimizing the risk involved in your investment procedure. So with this, I conclude my lecture. Thank you.